Joining me now are David Lefkowitz, head of US equities at UBS Global Wealth Management, Mark Zandi, chief economist at Moody's Analytics, and Peter Boockvar, chief investment officer at Bleakley Financial Group and CNBC contributor, who's here with me in studio. A very good afternoon to you all. Great to see you. Mark, I'm going to just start with you with a snapshot on the economy. Given what we heard from Brian Moynihan just there, are you as sort of relaxed about the outlook as seemingly he was?
I mean, I think the storm is in front of us and it's heading in our direction. And if things don't dissipate pretty soon, I know I'm stretching that metaphor pretty hard here, but you get the point. I think the economy is going to be in trouble. I don't think we've seen it show up yet in the consumer spending data. The consumers are telling us that they're really very nervous about what's going on. And, they haven't seen the tariff hikes flow through to prices yet. But once they do, which is an effective tax increase, I think that'll be enough to get them to pull back, and we'll start to see much softer spending numbers. So, no, I'm not nearly as sanguine about things. I think we should be on high alert.
David, you cut your S&P 500 target 6,400 to 5,800, I think, on Friday. As then tensions ease over the weekend, I mean, how quickly are you having to readjust that target? Are you wishing you hadn't cut it quite so much, or are you still think you kind of worth that cut?
Yeah, so thanks, Wilfred. So we did make some adjustments to our target price. That was really just incorporating our new base case for what we think the tariffs will be, which came in higher than expected. We don't think they're going to stay at these very elevated levels. But what we also did on Thursday of last week, when the Trump administration pivoted, in our mind, that means that we should pivot also. And so we upgraded equities to an attractive view. We think we're nearing peak policy uncertainty. We're getting so many contrarian indicators. The VIX is off the charts. Sentiment is horrible. Positioning is very depressed. All of these factors, when you take them together, suggest that there's a low bar for equity gains from here. And now that the recession risks seem to be lower, in our view, because of the adjustment from the administration, we think stocks can climb higher over time, but there is a lot of wood to chop to get there.
Peter, is the only challenge for U.S. equities the tariffs?
No. Stocks, I think, were vulnerable going into it. I think the DeepSeek news at the end of January sort of ended the AI tech trade in terms of its exceptionalism and dominance in terms of bringing the stock market higher. So when you lose 35% of the S&P in those 7 stocks and you add 3 more to get to 10, that's almost 40%. You've lost leadership. Then you throw in the belief that government spending is going to slow, and one of the major drivers of economic growth the last couple of years, not just economic growth, but corporate profits, profit margins, has been government spending. You slow the rate of increase there, you also create some vulnerabilities. So there is some fragility, I think, that was building even before the tariffs were laid on us, and now that, of course, obviously adds a lot more to the story.
I wonder, everyone's coming up with their updates of the likelihood of a recession or not. I guess the key question for me, has it become more likely than not? Have we crossed that threshold? And I'm keen to get each of your takes on this, but Peter, you first.
So I'll break down the 3 areas of main support to growth has been government spending, as I mentioned, upper income spending, and anything related to AI tech spending. If the stock market rolls over again and heads lower, that will have a direct, immediate impact on upper income spending. You cannot separate the economy and the stock market. AI tech spend is still very robust, but on a sequential basis, the rate of change on a percentage basis is beginning to slow. And as I mentioned, if you lose government spending, I don't know where there is other support in the economy to keep us out of a recession.
Mark, your take, is a recession more likely than not now or not?
It is. To give you a number, I'd say it's 60% probability of recession starting at some point this year. I mean, highly uncertain, obviously, because it all depends on the president, the Trump administration, and the tariffs and the trade war and what other countries do to retaliation. I mean, highly uncertain. I think there's still potential for an off-ramp here if the administration scales back, continues to scale back the tariffs and the trade war abates, then we can kind of navigate through. It's going to do a lot of damage. Growth is already slowing, as Peter pointed out, and it's going to remain weak. But we can navigate through without recession. That's the 40% probability. But with each passing day, that feels like the chances of taking that off ramp are becoming less and less. So, yeah, I think recession risks are very high here, uncomfortably high.